Hey everybody, Real Estate Ninja here. I hope you're doing great. I hope you like lives. Most people don't know this, but I film everything live, like 99% of my videos. Why? Because this world's too dang fake and I can't stand it. So this is me. Hey, so we're gonna talk about two stories today. We've got the 10-year Treasury yield surging a second day to 4.17%. That's not my words, it's their words on CNBC. As rate cut chances get pushed back further. It's almost like somebody knew this. Weird. How many of you knew that this was going on? All right, we're going to talk about that. Then we're going to talk about mortgage rates also jumping over 7% as stronger economic data rolls in. I don't believe this economic data. I think most of it's cooked lies. But it doesn't matter because we're going to take advantage of this. As rates stay higher for longer, it's going to be harder for the real estate market to get momentum, and it's going to just go. That's a technical term. All right, here we go. Oh, real quick. I just found out to get rid of all the trolls, all of the comments have been disabled unless you're on the live stream and you can just comment like crazy. But trolls can't get into the live comment, which is great. It will cost me $1,000 per channel per month to get rid of the trolls, the thieves. I can't believe that. I'm contemplating it. That is quite a lot of money. I could take that. It's crazy. So anyway, $3,000 a month is going to cost because I have 3 channels. Yeah, I got to figure this one out. All right, so here we go. The first story, 10-year Treasury surging. It says right here, the 10-year Treasury note jumped for a second consecutive day as investors weighed the path ahead for interest rates and the notion that cuts may come later than expected. Something they don't want to tell you right now is New York Community Bank is down another, I think, 6% as of the recording of this live stream. New York Community Bank is having problems. It's dropped like 45 or 48% in the last 5 days. Actually, I think 4 days. Why? They're having problems. They bought a lot of, I think it was Signature Bank's Signature Bank's crap, and it really was crap, and it is not good for them. There are other banks in trouble. I've told you this before, saying it again, we're gonna have ourselves a good old barn burner of a banking crash in 2024. What you experienced in 2023 with Signature Bank and SVB and all those banks, that was akin to the Bear Stearns moment of 2008. And then the crescendo, the end of the show was Lehman Brothers. Okay, so you had 2023, a banking crash that was the size of all of 2008 combined dollar-wise there, and now 2024 you get an amazing crash. We're going to take advantage of this. We're going to buy a bunch of real estate. It says the yield on the 10-year Treasury rose more than 14 basis points to 4.175. The 2-year Treasury yield was about 11 basis points higher at 4.476. Yields and prices have inverted relationship, and 1 basis point equals 0.01%. Let me explain this in layman's terms for me, because I'm a layman a lot. And that's the thing, because banking has become very difficult to understand, and it's by design. What they're not telling you is that we have a regional banking crisis. So yields are going up, not because of the narrative that CNBC is telling you is because, the Fed's going to lower rates. See, the bond market is working completely opposite right now of what the Fed's doing. It's going up, even though the Fed is not raising rates. Well, it's because people are getting a little scared. Like, wait a minute, Bank Crisis 2.0 just started. Why am I going to loan money into a market for a considerable amount of time when I believe that things are going to get scary, and it's going to go up? Rates will go up because fewer people will loan money into the bond market. Okay, that's what I believe is happening. Now, the other story, that's just telling you about what's going on in the bonds, right? You go click back on old CNBC. Come on, phone, let's move faster. All right, here we go. This is about mortgage rates. The average mortgage rates jump back over 7% as strong economic data rolls in. It says the average rate on the popular 30-year fixed mortgage crossed over 7% on Monday for the first time since December, hitting 7.04%, according to Mortgage Daily News. It comes after the rate took the sharpest jump in more than a year Friday, after the January employment report came in much higher than expected. Rates then moved even higher Monday after monthly manufacturing report came in high as well. Mortgage rates have been on a wild ride since the summer, briefly crossing to a 20-year high of 8% in October. Rates then fell sharply as investors saw more and more evidence that the Federal Reserve would end its latest phase of interest rate increases. Mortgage rates do not follow the Fed directly, but they follow loosely the yield on the 10-year Treasury, which is heavily influenced by the Fed's impression of the economy at any given time, which is pretty much telling you it goes based off the Fed's rate. It says here, the rapid increase is a great quote. The rapid increase in rates over the past 2 days is actually not too surprising given the fact that the market was widely seen as over-optimistic on the Fed rate cut outlook. See, what's great is that they don't tell you anything about the banking crisis that's happening right now. Don't. They're sure there's a building on fire over there. Don't look at it. Everything's fine. They say the Fed has repeatedly pointed to the economic data and having the final say in that outlook, and that data has been shockingly unfriendly to rates as of Friday morning's jobs report. Now, that is absolutely true. See, the Fed is data dependent, and they love to be able to blame other sources like data for their misguided, rate policies. And they got us into this in the first place, diving it really low and then bringing it up really high. And then they're going to someday bring it down low. But again, when they bring rates low, that's because everybody's losing their jobs. Everybody's hurting. Nobody's ready for this. That's why we're getting ready now. As mortgage rates fell over the past 2 months, buyers seem to be returning to the market. That coincided with a slight uptick in the number of home sales. Okay, just so you know, that's actually not true. You got to take all this in context. Sure, home sales rose a little bit, right? But you have to look at at record low amounts of velocity. Okay, they're record low. We're talking we haven't seen home sales in the nation this slow in the last 30 years. Okay, so they go, look, it's rising. Yeah, it's still super low. Okay, cool. You're like a 25-year low. And what? It's month? We're dealing with seasonality adjustments too. The real true health of the real estate market is shown in the spring and summer. Okay, that's when it's the hottest market, when people have their tax return in their hand and they're just ready to go out there and crush it. And if you don't see that pick up and go to normal levels, and when I say normal levels, I'm talking about 2019. And 2019 was a little bit of a dip. Maybe you want to go back to 2018, 2017, but you can't compare it to the early start of the shutdown, right? 2020, 2021, early 2022. You can't. That is an anomaly. And you have to remember, I was looking at some condominiums a little while back. They were like 800 grand in 2019, 2020. And now they're 1.4, 1.5. Okay. That's not sustainable because as fast as it goes up is about as fast as it goes down. People need to understand that. So mortgage rates are ticking up. I think there's going to be a lot of FOMO in the market. And when I mean a lot, it's still a little bit of volume, but there's just going to be a bunch of people going, I gotta go buy a house, I'm freaking out. It's okay. Don't worry. Don't sound like Mickey Mouse. Come on, man. My point being, that's a horrible Mickey Mouse. My whole point is that if you just wait and you save and you watch and you let the deals come to you, you're going to absolutely crush it. Hope you guys got something out of this. I just got to go. Ninja's out. See you guys. Have a great day.